Welcome back to Fast Market here on the TD Ameritrade Network. Let's bring in our next guest for our cash tag segment, and that's going to be Landon Swan, co-founder of LikeFolio. Thanks for joining us again, Landon.
Thank you, Tom. Good to be here.
All right, so we're talking Disney. Down in your home state, Walt Disney, they started cutting jobs. But Landon, I looked at a chart on this stock over a 2-year period. 2 years ago, the stock was $180, now trading about $101. It's had a decent run here in 2023, but what kind of data do you have out of LikeFolio? Any surprises here?
Yeah, I mean, this stock, like you said, has been cut almost by half in the last 2 years. And over the last year, it's down, what, like 5, 6, 7%, something like that over the 1 year period. So not a great run for Disney investors, although the last quarter was good. They beat on the top line and the bottom line on Bob Iger's return. He turned in a good one on his first report back. And they talked about how they're restructuring into 3 different units: the Disney Entertainment, ESPN, and then the Parks, Experience, and Products. And if you look at the entertainment first, that's one I think where we have the most concern. So, they actually said that they're not going to give guidance on subscriptions anymore after losing 2.4 million subscribers. And that was following a price hike. And one of the things that we look at is, how's streaming doing overall? In general, streaming is down about 3% just across all streaming platforms. But when you focus in on Disney, people are talking about canceling Disney about a little bit more than they were last year, plus 5%, not a huge number. But the real concern here is that about the number of people talking about new subscriptions, they just signed up for Disney, that's been cut in half over the last year. And people talking about watching content is down 70% over the last year. And I think a lot of that has to do with the fact that they're just not putting out a lot of new content. They are competing with the likes of Netflix and all the others who are churning out content nonstop. And Disney, we've talked about this before in the past. When you sign up for Disney, might go on there and watch a lot of your old favorites. And then you say, okay, what's next? And, they had like The Mandalorian that has a few seasons in. But other than that, there's nothing like pulling you back week after week to get you to watch more. So I think they really need to step it up on the content side of things. This is, in my opinion, their weakest division, and it should be probably one of their strongest. So definitely struggling there. The second division that they looked at was ESPN. ESPN Plus down about 5% on a year-over-year basis when it comes to viewership. Nothing dramatic in that area. Like I talked about, streaming's down 3, ESPN Plus is down 5. So it's kind of holding the line, maybe just a little bit behind, nowhere near as far behind as Disney Plus and the other streamers. And then the third division is the Parks, Experience, and Products. And we look at the parks, one of the things we like to look at is how many people are going to the website to actually plan their vacations, to plan the Disney Parks experience. And that's up about 2% year over year. So it's holding, it's doing fairly well, it's gaining a little bit. In the last report, they talked about that this division had revenue of plus 21% year over year. I think a lot of that has to do with increase in ticket prices and getting more, frankly, out of each customer. Now you've got the Genie Plus, which is $25 per person. You've got the Lightning Lanes, which is $16 a person. They're just finding ways to get a little bit more out of each person. It kind of reminds me of if you go to the airport, you got to have your TSA pre-check, and then if you want to go to the next level, you got to have clear. So that's Disney's kind of taking that road. Is like, how long do you want to wait? So you're paying for your time or not having to wait in lines. So they're able to get more out of customers. I think that's really key. This is the biggest one for me. I mean, this is the steady Eddie here. This is the division that is just going to continue to crank out money. I really think there's just nothing like their parks and experiences, and it's just a destination. I don't think that's going away. This is what I think if you're investing in Disney, this is the safe part of the investment, and then you're really hoping that the subscription part, the streaming part can take off, and that's sort of your growth engine. But this is the safe part of your investment. I think so far investors have been disappointed with how the streaming side of things have gone, and that's why we've seen the stock sell off so much.
Landon, I think you're right. I think the theme parks are going to put up impressive numbers as they usually do. I think the direct-to-consumer streaming is going to struggle as it has in the past. I think linear media is hurting, as you know. ESPN's probably part of that, although ESPN will probably be one of the brighter spots in that. But Landon, when you take this all, the good and the bad, and you add in, he's going to cut costs. The estimates are for $5.5 billion in cost cuts between now and 2024, and he's going to get Disney Plus positive earnings by 2024, probably by slashing expenses. That could take some of the bite out of some of the weakness in this name. That's the way I look at it, because Bob Iger, say what you want about him, but he is a dynamic, impressive CEO who, if he doesn't see the revenue on one side, he's going to attack the expenses on the other side and cut headcount as he's already done. He's going to cut costs. So I think there will be some bad news in there, but as we've seen in this earnings season, cost cutting is going to be a positive for Disney when they release their earnings. Your thoughts?
I agree. I think if you're investing in Disney here, right at $100, right over $100, you're betting on Bob Iger. You've got this PE ratio; it's around 55, which is fairly high, I think. But there's two ways to take that down, right? I mean, you can either increase the revenue or you can decrease the expenses, and your earnings are going to go up. So that PE ratio can sustain that. So that's going to affect the PE ratio positively. So. Yeah, I think that cost cutting has to be done. I do agree. I like betting on the man, frankly, and I like having this parks and entertainment division that's just foundational to the company. You know it's going to stay there. You know it's going to continue to do extremely well. That's tried and true. It's battle tested. And then it's just a matter of getting upside, right? You've got to get the upside from the streaming. I don't think that, they're not going to be opening tons and tons of new parks. There's not a huge amount of growth in that, but it is going to continue to churn out more money as they get more people coming in and more money per customer, which they've shown a huge ability to do. I mean, this is a very elastic, or somewhat inelastic, demand. People are going to Disney World and they're spending whatever it costs. So I love that. But then again, you just got to get something going out of the entertainment side. And I think it's been somewhat of a failure so far. But if he's cutting costs, the only concern that I have there is, what are you doing about the content? Because you've got to have new content. If you're going to compete with all the big players that are putting out shows left and right, you've got to have new stuff, and that does not come cheap. So it's either going to be acquisition of content or create it yourself, and those are both fairly expensive.
Landon, that's kind of the point of my question here going into this is, they're pulling back on content creation because that's a huge expense. All these streamers are losing money, or most of them are, because of that. Disney has a cachet of, basically content they already have, but they're dropping people. Is the street too focused on the streaming side of their business and not the parks and rec and maybe the partnerships that they have, the movie business that they have? And, what kind of happiness levels are you seeing out of this? Because I know that's a key metric you guys follow.
Sure. Yeah. Happiness levels are strong. They're very strong with this company. That streaming took a dip on the price hike, but other than that, I mean, the parks are always extremely high. And I think that's one of the reasons that it's done so well. But again, what kind of company are you investing in? I think if you split this company into two, and you had entertainment and streaming and even ESPN Plus on one side, and you had the parks on the other, the parks would not justify a PE ratio of 55. I don't think. I think they're going to be very steady. They're not wouldn't be a growth stock, in my opinion. It'd be just sort of like a dividend stock almost, right? It's just going to crank out money. But what would the other side be? I think that's the side where people are looking for growth. So I think that's why investors have looked so heavily into what are the subscriptions, what are the, how many people are coming in and signing up for this, and what's the retention rate. It is concerning that they're not giving guidance on that anymore. And so the fact that we've got new subscriptions cut in half, people watching it down 70%, I think that's going to hurt the stock price, because for better or for worse, that's what investors are looking at, because I think the parks are sort of a known and the streaming is a bit of an unknown, and that's the pie in the sky. Maybe we can get there. This is how we justify this high PE ratio. That's what makes us a growth stock. That's sort of the story that's being told, at least in investors' eyes. And you got to follow through with that if you're Disney. So either get rid of it and just go back to being, the parks and ESPN, or if you're going to have it, you've got to crush it, and it's going to be expensive. So I'm really interested to see how they come across on this earnings call and what those numbers looks like. Is the focus shifting at all away from streaming, or are they just, one option you could have is just say you can have access to everything we've ever done, and it's a small monthly fee, as opposed to trying to compete with Netflix and create new content all the time. There's a lot of ways they could go about it, but in order to justify that 55p, you've got to have a lot of growth.
Yeah, and do you have an earnings score going into this one?
So we don't with Disney. We don't actually track every brand that they have. We break it down into different sections. So we don't have a specific earnings score. Personally, I would say that 100 as a support, is just one of those old school technical things. I think that if it goes under that, people are likely to buy it. Every time it's gone 10 or 12 bucks under that in the last year, people have bought it back up to 100. We're sitting at that level right now. I do like that. I like betting on the man, frankly, Bob Iger, and then I like the safety of the parks revenue, but I just worry that the PE ratio is too high without growth from the content side.
Yep, and after that initial pop on last earnings, this stock is now below the levels that it was prior to that pretty decent report on the expense cutting side also. All right, great data as always, Landon. Appreciate it.
Thank you, guys.
All right, that's Landon Swan, co-founder